I mean, what I see coming up is a very, very nasty collapse. And when you get a collapse of the fiat currency system, nobody's going to really be able to afford the lifestyles they have at the moment.
Maybe we found our new reality up here for the next launch, for the next phase. And I still think silver's going, this year sometime, somewhere between $300 and $500 an ounce. I still hold with that. I don't have any macro technical reasons based on our methodology, momentum-based structure, to assume otherwise. This is not 2011 top. We call that top 2 months after the high and said, that's it, it's over.
The transition from a fiat-dominated world to a commodity-backed reality is accelerating, signaling a nasty structural reset for global lifestyles. As the debt-based regime reaches its terminal phase, the current volatility in precious metals is not an exhaustion point but the foundation for a massive launch into a new economic paradigm. Alasdair Macleod, head of research for Goldmoney, and Michael Oliver, founder of Momentum Structural Analysis, argue that we are witnessing the birth of a new price floor rather than a 2011-style market top. According to current momentum-based structures, silver is positioned for an unprecedented revaluation with technical targets sitting between $300 and $500 per ounce before the current cycle concludes. While gold has retested the $5,500 level following the escalation of global conflict in early 2026, silver's backwardation, where spot prices remain roughly 50 cents higher than futures, proves a severe physical shortage. Unlike the 2011 peak, which was called out by these analysts within 2 months of the high, the current Q1 2026 data shows no momentum breakdown, suggesting that the most violent stage of the rally is still ahead as the dollar's purchasing power continues its double-digit annual decline. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Yes, it was a massive correction. But since then, and I just sent you some charts, I mean, if you really stand back and instead of looking at a daily chart of gold or silver, you just go to your quote screen and punch up a monthly continuation chart of gold futures or silver futures since late December, early January. It's not really down. It's sharp ups, sharp downs, sharp ups, sharp downs, redundant territory. And so whenever there's a down, we get the emotion like, oh, it's all over. And when it goes back up, everybody sort of gets quiet and a little bit happier. It's been months, a couple months of this now, constant down, but they don't seem to keep going. Okay. Maybe we found our new reality up here for the next launch, for the next phase. And I still think silver's going, this year sometime, somewhere between $300 and $500 an ounce. I still hold with that. I don't have any macro technical reasons based on our methodology, momentum-based structure, to assume otherwise. This is not 2011 top. We call that top 2 months after the high and said, that's it, it's over. Okay. Same at the bottom in 2015. There was massive clear momentum trend structure, not just looking at a price chart. Price chart didn't really give you a big clue. But right now, everybody's looking at price thinking that's it. No, it's a congestion zone. Yes, it's violent. Why not? The market trend itself has become far more vertical and violent. So therefore, the congestion zone is not going to be pipsqueak quiet. It's going to be violent as well. So don't fear every drop. And frankly, we've got a very short-term analysis, which I sent you today. Today's drop, the bears better keep it going like right now. Today, tomorrow, the next day. If they don't, going right back up. Which case, all the bears will say, well, I got to get back in again. How do I do that? And they won't get back in better than where they got out, I'll tell you that. So, anyway, that's our assessment of that.
What is the COMEX actually doing? I mean, we know from the Hunt brothers that they're not above changing the rules when things sort of cut up kind of rough. So, what's new in that? I know also from my interaction with regulators when I was a broker and a banker that they actually treat the smaller guys a lot more viciously than they do the big boys. So big banks actually can get away with quite a lot. As was shown, you had a JP Morgan dealer who was on the board of the LBMA who ended up in jail. I think he ended up in jail. Either he did or his, I mean, so in other words, you can be in a big bank and corrupt, and because you're part of the establishment, absolutely fine. So I think that's one aspect. The other aspect is that when it comes to market making, which is essentially what these guys are doing, then they don't need necessarily to work together in the same direction because they can suss out exactly how the market feels. It's their business, and they're the right side of the quote the whole time. And they know when it might be a good moment to just bang the price and shake the trees and close a few bear positions. And it might create the impression that they're working in concert, but actually, if you're on the short side and a few other guys are on the short side, you tend to be getting the same signals. So you don't actually have to go and sort of get on the phone and say, I think this is the moment when we've got to bang the market. I mean, the answer to that basically is that people who complain about the behavior of market makers, first of all, they can't really establish anything. And B, the lesson in that is that if you're playing in the market, they're far bigger players than you. And you're going to, and this is why most traders actually lose money. By number, most traders, if you like, small traders, I mean, they go in and they think, it's time to buy gold or it's time to sell this or whatever. And they inevitably get it wrong, partly because they're probably headline driven rather than anything else, but mainly because they're part of a herd. You think you're independent in terms of your view, but you're not necessarily. There are other people doing exactly the same thing, and the market makers can suss it out. So my view on this is, so what? I mean, you've got to understand really what's happening and deal on that basis rather than, sort of complain when things don't go quite your way. I mean, the system is what it is. It's, it may be full of cheats and, fraudulent behavior and all the rest of it, but you've got to accept it if that's the case. But very often, dealers basically, they know where the stops are. They know when the pace of buying slows, and they therefore know when it's a good opportunity to just bang the price, take out a few stops, and in the process, close some bears. Thank you very much.
The recent volatility in the precious metals market is not a signal of a trend reversal, but rather a high-velocity congestion zone setting the stage for a massive secondary launch. While daily charts may show sharp declines, monthly continuation charts for gold and silver futures reveal a resilient, vertical structure that remains firmly intact. This is not a 2011-style exhaustion. Instead, the current sharp-up, sharp-down price action is a characteristic of a market entering a far more aggressive phase. Speculators who exit on these emotional dips risk being left behind, as the momentum-based structure still points toward a primary target between $300 and $500 per ounce for silver later this year. Understanding the mechanics of the COMEX is essential for navigating these shakes. Market makers leverage their position to suss out retail sentiment, hitting stops and banging the price to close out short positions at the expense of smaller, headline-driven traders. This systemic manipulation is a reality of the established financial architecture, where big banks often receive preferential treatment compared to independent players. Rather than reacting to the noise of these engineered sell-offs, sophisticated investors are recognizing this as a necessary clearing of the decks before the next vertical leg up. Let's get back to the interview.
We've got, the private credit situation and its close cousin, which nobody seems to be talking about, and that's private equity. Basically, both of those sectors cannot afford, they cannot afford current interest rates because they leveraged up when interest rates were zero or in some countries negative. And bond yields, you had a 30-year bond yield at 1% or 0.75% in the US, for example. That is when they all leveraged up because everybody believed that interest rates were never going to go up again. And of course, it caught out a few of the regional banks, as we might remember. But when you look at sort of this private credit. What this basically is it's intermediaries, if you like, financial intermediaries raising funds either in the form of bonds or off bank balance sheets at one rate and lending it to others at a higher rate. So in other words, they're taking a nice little interest rate turn. There may be some profit arrangement in there as well, whatever. If you look at that and you also look at the private equity industry, I mean, we've got a classic example in the UK, Thames Water. Thames Water, nice utility. It's regulated. The regulator tells all the water companies how much they need to spend on investing in infrastructure and all the rest of it, and how much they're allowed to pay their shareholders. And in the case of UK water companies, you're looking at a limit of about 8%. Well, you've got a steady income of 8%, come hell or high water, ha ha. This is just lovely stuff. You can leverage it up and turn 8% 5 times into 40%. And that's basically what private equity is doing. Private equity is a huge, huge industry. Now, guess what? On the first ramp up we had in bond yields, Thames Water had to start refinancing, and basically they're bust. And they have struggled, but they have to be rescued. They have to be rescued. Otherwise, nobody in London's got any water. It's the sort of thing. That is what's happening. And this is undoubtedly going to impact on the financial sector. I just hope that some of the banks that Mike mentioned, if you like, have actually sort of reduced their exposure to this, pushed it, if you like, into sort of public funding through bonds and through mutual funds and all the rest of it. But it's going to be very, very difficult for them to navigate through another rise in interest rates and bond yields, particularly bond yields. Now, whether the Fed goes with interest rates or not is an interesting point, because if you look at the financial sector as a whole, including equities, we are in the biggest bubble in history. Remember that credit going into that sector, the other side of it is debt. And we've seen how the debt has been running, both in government and also in the private sector. And this debt is not being deployed productively. It is being deployed speculatively. We have the biggest speculative bubble probably in history. We can certainly trace it back to this financial age, which started with Big Bang in London in '84. It is probably bigger. It's twice as big as the dot-com bubble, incidentally. And it is also considerably larger than the Roaring Twenties in 1927 to 1929. When this one bursts, it's going to go bang in a huge, huge way. So what does Powell do? It's going to happen now. I mean, I think we're on the beginning of it. What does Powell do? Well, he's got to follow a political mandate. And that is, he's got to rescue everything that needs rescuing. Now, under those circumstances, effectively what he's doing is, instead of credit going bust and being valueless, he is trashing the dollar. He's devaluing the dollar to ensure that the credit doesn't go bust. So he's wiping out the dollar. And that's what we're going to see in the coming months. And it's going to add fuel to the problem that we have with rising commodity prices, etc. We are on the edge of a chasm of credit destruction, such as we've never seen before. And the financial sector, the weakness in that sector, I think is beginning to reflect that fact. It is ahead of the curve, if you like. Whereas the rest of the market is sort of, it's a nothing burger. It's just moving sideways, really, at the top. So that's my take on that one. I mean, what I see coming up is a very, very nasty collapse. And when you get a collapse of the fiat currency system, nobody's going to really be able to afford the lifestyles they have at the moment. There's going to be widespread discomfort. I mean, health services will not be available. I think, food will be in very short supply. I mean, we've seen these things before, not necessarily in our own economies, But go to Germany. I mean, they've had that as a result of two world wars. This happens, and you've got to understand whether this is going to happen again or not. And so that's my mission, really, to help people navigate their way through these difficulties.
The convergence of a systemic private credit crisis and a hollowed-out private equity sector has placed the global economy on the edge of a chasm. These industries, leveraged to the hilt when interest rates were near zero, are now facing a brutal refinancing reality as bond yields surge. The failure of regulated utilities like Thames Water serves as a canary in the coal mine, proving that even steady income streams cannot survive the weight of five-fold leverage in a high-rate environment. We are currently witnessing the bursting of the largest speculative bubble in history, one that dwarfs both the dot-com era and the Roaring '20s. As the credit destruction accelerates, the Federal Reserve faces a binary choice: allow a total systemic collapse or sacrifice the dollar to rescue the establishment. Jerome Powell's likely path of choosing devaluation over default will effectively trash the purchasing power of the dollar, fueling a massive second wave of commodity inflation. This transition will bring widespread discomfort, disrupting essential services and food supplies as the fiat system enters its terminal phase. To protect your family from this nasty collapse, you must move into the only assets the Fed cannot print. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.